You think about the economy right now, the fact that we've been living in this higher for longer environment for what feels like a long time at this point. On the cusp, of course, of the Fed's June meeting, how rate sensitive is corporate America and the economy overall right now?
Well, clearly not that very sensitive. As Mike pointed out, consumers and business spent the last decade refinancing, locking in those very, very low rates, particularly long-term rates. So they really are not as sensitive to increases in short-term rates as previous cycles. We've only had one negative quarter in the beginning of 22, so it doesn't look like there's a recession. So it looks as if the economy is just going to chug along at a modest rate, and inflation looks like it wants to stay a little bit higher than that Fed's 2% optimal rate. So I think the Fed's a little bit flummoxed because the market isn't doing what it should do according to their rule books.
And I'm looking through your notes, and I see here that you take a look at the economy and that basically that even with cuts, I mean, this economy could continue to advance. And I read something like that. I think about the Fed's perspective right now. Should we be talking about hikes? Whether or not you actually see that as a possibility, should we be talking about hikes here?
Well, I think to me it's really a rather mixed picture, and frankly, I don't think a quarter-point lowering of rates will really have any impact, material impact, in the real economy, especially, as I said, because the economy really has not proven very sensitive over the last couple of years. So whether they do or they don't, I don't think that's really very much a determinant for stocks. I think the economic outlook looks stable, maybe even a little bit improving. So that says to me the stock market has the ability to continue to move up for the rest of the year.